Okay, let's dive right in. On October 30th, the crypto market got absolutely hammered by a massive, violent sell-off. So what on earth just happened? We're going to break down exactly what went down, why it happened, and what this could all mean for the future of this bull run. The story of the day really boils down to one single staggering number. $1.2 billion. That's the value of leveraged positions, trades made with borrowed money that were just completely wiped out across the entire market in just 24 hours. An absolutely brutal day for traders. So $1 billion, how does that even happen? Let's get into the specifics and really unpack the scale of this market correction. All right, let's look at the sheer scale of the impact here. Bitcoin's price took a tumble, sure, about 5%, but the real story, the human one, is that nearly 250,000 individual traders were liquidated. And get this, the vast majority, almost $1 billion worth, were from long positions. These were folks betting the price was going to go up. Bitcoin and Ethereum, of course, took the biggest hits, with nearly 600 million in liquidations just between the two of them. Now, a crash like this, it rarely just happens in a vacuum. This wasn't just some random crypto volatility. Now, this was triggered by a perfect storm of three huge macroeconomic events that all slammed into the markets at the exact same time. And this is just a brilliant illustration of how interconnected crypto is with the wider financial world now. First, the Federal Reserve cut interest rates, which, is usually good for assets like Bitcoin. But Fed Chairman Powell sounded super cautious about any future cuts, and the market absolutely hated that. Second, positive news about a trade deal between the US and China created a sell the news event. It's a classic market reaction where investors sell off once the good news they were waiting for actually happens, just to lock in their profits. And finally, you had fears of an AI bubble sending tech stocks tumbling, and all that negative sentiment just quickly spilled right over into crypto. Okay, so let's move over to the corporate world and see how this builds an even more complicated picture. Because while the market was in total turmoil, the big players were making some very, very interesting moves. So take MicroStrategy, the largest corporate holder of Bitcoin out there. Their Q3 earnings report was, well, it was a mixed bag. On the one hand, they posted a massive $2.8 billion net income, and they're sitting on huge unrealized gains. But on the other hand, their profit was down, their pace of buying Bitcoin has slowed, and their stock got hammered in October. It really shows a company that's profiting immensely from its Bitcoin strategy, but is also definitely feeling the pressure of this current market. But in pretty stark contrast to that mixed signal, other major corporations showed some incredible confidence this quarter. They were using this volatility not as a threat, but as a real opportunity. And this shows that conviction is still running high in some really crucial corners of the market. I mean, Coinbase didn't just beat its revenue estimates, it went out and bought another $300 million worth of Bitcoin. We also saw Jump Crypto, a major trading firm, sell over 200 million in Solana to move into Bitcoin. That's a classic flight to safety within the crypto world. Even SpaceX was seen moving millions, which just keeps the market guessing. To really understand the immediate selling pressure, we have to follow the money, and specifically the money flowing out of institutional products like those big Bitcoin ETFs. This chart tells a very clear story. On the Wednesday of the crash, nearly $500 million was pulled out of the major Bitcoin ETFs. You can see big outflows from Fidelity, ARK, and BlackRock. This shows institutional investors were hitting the sell button, taking profits and reducing their risk right after the Fed's announcement. Now for traders, this is where the real alarm bells started ringing. The price didn't just fall. It broke clean through key technical support levels. It dropped below the 200-day moving average, which is a major long-term trend indicator. It also failed to reclaim that 113K level, which is the average price short-term holders paid. So the next big line of defense is that psychological $100,000 mark. This technical breakdown is why analysts like Glassnode are warning that a deeper 20 to 30% correction is now very much on the table. So with all this chaos, the market is now fiercely divided. You've got two powerful and completely opposing viewpoints emerging about what in the world happens next. And this slide really lays out that fundamental tug of war. The bulls, they see this as a buying opportunity. They're pointing to accelerating institutional adoption from giants like Nordea Bank and JPMorgan, historically low supply on exchanges, and the fact that November is usually a strong month for Bitcoin. On the other side, The bears are arguing the bull run is over. They see the broken technical support, a surging US dollar, extreme fear among retail investors, and bearish momentum signals as clear signs that the party is ending. Amidst all the noise and the panic, MicroStrategy's Michael Saylor, one of the biggest Bitcoin bulls in the world, tweeted out this simple but powerful statement: "The battle begins." He just perfectly captured the mood. This is the moment where the convictions of bulls and bears are truly being put to the test. And this leaves us with the critical question every single investor is now asking themselves. Is this sharp, painful drop just a healthy, necessary reset in a larger uptrend? Something to shake out the weak hands and create a prime buying opportunity? Or is this something more serious, the first major crack that signals the beginning of the end for this cycle's bull run? Well, the next few weeks will decide which narrative wins.